I often tell clients not to make any major investment decisions based on the elections, and I'll give you some reasons behind that. One, if you are thinking that it creates a whole lot of uncertainty around policy and geopolitical risk and other things, I will tell you that the more uncertainty there is, the higher the market returns tend to be. Meaning that if that uncertainty is very visible, sometimes that can just allow the market to climb the wall of worry. And you can look historically and measure uncertainty. The NFIB, or Small Business Survey, is the most uncertain that it's ever been, with data back to the 70s. So that's cautionary note number one. Cautionary note number two is, if you think about government policies and what they mean to equities, sometimes you see the opposite results as you would think. We saw that in the recent administration with green energy stocks. As much as we saw one of the biggest policy pushes that we've seen historically, green energy stocks actually underperformed over the last 4 years and even over the near term after the policy was started, because starting points matter, specifically on valuation. We saw the opposite side of that in the mid-1990s with healthcare reform in the US. Healthcare reform was largely perceived, with the introduction of HMOs, to weigh on corporate profit margins specifically for healthcare companies. And it did. But healthcare went on to be a leadership sector and outperform the market for the better part of the next 5 years. So sometimes you can see situations around the elections that are buy the rumor, sell the news. And there are some areas of the market that do provide opportunities, even regardless of administrative change. I'll put one in each camp for you. I think that as it relates to fear around tariffs and higher deficits, with the relationship between them causing the higher yields that we've seen, that might be a situation that falls more into the perhaps buy the rumor, sell the news. When you look at tariffs over time, they're not inflationary. The two historic instances we've seen, Smoot-Hawley, was deflationary, and our most recent trend in 2018 also didn't see broad-based inflation. So I think that that's one thing for investors to consider in terms of maybe perhaps not being so fearful of. Two other areas that we did see market movement around the election, I think still have legs, and that's financials and small caps. Not as a result of the election, but because of the setup going into the election. It's a situation in both small caps, mid caps, equal weighted stocks, and the financial sector where you have very wide valuation spreads, which is just a measure of fear. So if you're nervous about regulation change, I guarantee you that the stocks were nervous as well. And again, the more visible that is, the more likely it is to be priced in. You couple that wide valuation spread with relative valuation support when the stocks are bottom quartile in terms of the relative valuation when we measure it historically, and that has mattered in the past, plus a catalyst of interest rate cuts, usually providing both an impetus for relative earnings growth and for relative multiple expansion. So I think that those are the areas of the market that did provide an opportunity going into the election, that further provide an opportunity coming out of the election.